Hey, this is Leo. So let's talk about the S&P 500. I've had quite a few people just seen comments and messages talking about how bad could it get as far as the stock market goes. A lot of people worry about their retirements, especially as we have this large age group um, moving towards retirement. So I mean, it's obviously a concern as you're seeing your portfolio value go down and down and down. So I'm going to take a moment here and we're going to go over the worst case scenario for the US stock market. And that would be that you have completed 5 impulse waves up. So this is going all the way back to the 1800s where you have first wave, you get the Great Depression being a second wave, and then you go on this massive run from the 30s all the way up to, well, pretty much where we are now, but the third wave would be the early 2000s where you have the dot-com bubble. Then we go up and we hit '08, and then we obviously go down again. So after you have 5 waves, what comes is a correction, right? So you typically that would mean that actually what it would mean is that you have a completed first wave of a higher degree. So if you come here, I'm just going to put this on here real quick just for demonstration. So those 5 waves, right, the 1, 2, 3, 4, 5 we just went over would make up the first of a much larger degree. So then you would put in a second wave and we'd be off to new highs. So how low will the second wave go? Well, the most likely target is a 50 to 62% retracement. So what would that look like? Well, if we come down here to $2, where the S&P 500 was long time ago. Actually, the S&P 500 wasn't around back then, so this is all just aggregate data. But anyway, so if we just draw from the low all the way up to the high, you can see that the 50% is lining up with the 200 monthly moving average, which is the white EMA. And what I think you'll notice is that it's actually not that scary if this scenario were to play out, because ask yourself, because it looks worse than it is, right? Because you see price, it's gone all the way up to $4,800 because all the stimulus money and whatnot that the government had done. But if you simply ask yourself, because I know there's a lot of people out there that are, they're feeling really depressed, they're upset because of losses and how much the stock market has declined. They worry about their retirement. Am I going to be able to retire, et cetera, et cetera. But if you simply look at it a different way, don't look at it as, well, up here it was $4,800, right? And well, now it's $3,800. So I've lost $1,000 if I had one share of the S&P 500. Okay, so ask yourself, if you go back in time 2 years ago, right? How bad were you? Well, you really weren't that bad, right? Because if this price action wasn't here and we're just looking at this, well, you'd be ecstatic, right? Because, you're at the all-time highs of the S&P 500. You're doing just fine, retirement in 5 years or whatever. Whereas now, if you're looking at it and we're way up here and we've come down, okay, well, now you're seeing it and you're like, I'm doing so bad. I've lost so much money from the highs. When in reality, if you just wind the clock back 2 years, it's really not that big of a deal, right? So if we're coming down here to the 50% retracement, and again, this is worst case scenario, you would just be looking at your portfolio value being what it was 2.5 years ago, 3 years ago. It's not all that. It's not horrible. It's not what it was up here, but you're going to survive, right? Because the difference in time, it's not all that great. And typically within the stock market now, we're seeing more of these V-shaped recoveries because of what the Fed can do with their stimulus money. They come in, they start pumping the market again, and Papa Powell ends up saving the market. So while headlines on news stories say, the huge crash coming, we're going down 30%, yada, 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 that gets attention, and it might be why you clicked on this video. Worst case scenario, what's going to happen? But in reality, it's just winding the clocks back. We're just going back in time 2-3 years, and that's where the stock market would be on a worst case scenario. So we have structural support here, being that price lingered in this area for a while. And whenever you see price linger in an area, it means that there's a lot of price acceptance. It means that the market accepts the price there, right? So whenever you see a market go on a rip like it did here, it's because there's no prior price history, right? So we're in price discovery. We're trying to find an area of price acceptance. And so that's what happens up here as price starts to consolidate. People accept it there. They're buying, trading it back and forth. And then as it breaks to new highs, it finds new price acceptance. So if price does come down here, I find this area very strong support. I find it unlikely it would go this low. You would really need something catastrophic to happen, mass liquidation type stuff, to be able to break the 200 monthly exponential moving average and get through this structural support. So hopefully that gives some comfort in that. I think absolute worst case scenario, the floor would be 2400, right? Absolute worst case scenario. And I don't even know that that's likely. I think we're in a similar period to the 1970s, where we were dealing with high inflation and the market more or less moved sideways. It had some very steep drops in the 70s. So we can come back here, take a look. You see how you have these big drops, but more or less it moved sideways for a period. They call that a lost decade because your real return in the stock market, you didn't really have one, right? So if you invested in the 70s, your portfolio more or less stayed the same. It just oscillated back and forth. This year it might be down, next year it might be up. This year it's down, next year it's up. Eventually, once you got through that period of consolidation, your portfolio was off to new highs. So I think it's more likely that we're in a scenario like that than we are of the market just absolutely crashing down to 2400. Could be wrong though. We can also look at the Fibonacci's for more support. So if we pull up Fibonacci retracement from the low here, you'll find that they bought at the 50% retracement like I was just talking about. And so the way that these Fibonacci's work, the way the computers are programmed to buy, is because price ran so far past the negative 236, so I'd pull from the high up to the new highs that it has made. And you could see that the first time it came down, they bought at the 50% retracement, went up, and then they came down again, and where they bought at the 618. So once again, price has skyrocketed past the negative 236, so they would pull another extension from the high here. And you could see how during the my page would load any second now. Come on. Okay, there we go. So you can see that yet again, they bought at the 50, continued to buy down to the 618. So 62% retracement, and it shot up again. So if we pull an extension, right, you can see that we are currently at a 50% retracement. Interesting. So it doesn't guarantee anything, but seeing a very bullish candle like that on the monthly time frame at the 50%, at the 55 EMA, at the median line of the pitchfork, it gives me some hope, some confidence that perhaps the bottom is in. If it's not in, then I would expect it to go quite a bit lower. But most likely, I think that it's either in or very close to being in, and it would just oscillate sideways. Maybe it goes down a little bit, but not too much. But if, for example, next month, you see a really bearish bar come in here and just completely engulf this one and start breaking down, you would know that the next support is significantly lower, down at 2400. So looking at the long-term algorithms here, the Fibonacci's, it's looking good. It looks good that we're getting a reaction at this 50 where they have engaged, they started buying the price up. So just have to kind of keep an eye on that and see what happens. But big takeaway here is to not freak out that, oh my gosh, the stock market was at 4,800, now it's at this price. Just think about it in time. Okay, well, was I depressed and upset that my portfolio was down looking back 2.5, 3 years ago when it was at the all-time high? Well, no. So why would I be horribly upset about it being back? Essentially, you lose 2 years of gains, right? But once that bottom is in, then, it goes off to new highs. I think a lot of people, they think of stock market crashes and the Great Depression immediately comes to mind, and they think that we're going to see a 90% drop in the stock market and it's going to go all the way down to $100 or something like that. And it's just not realistic, especially nowadays when information is just moving so fast. We typically are seeing a lot quicker corrections. So if we do get a very sharp drop down here, I think that it'll be a very quick recovery. So within a couple of years, we'll be, back at all-time highs. I don't think it'll be as bad as people believe. So until next time, I'll talk to you soon.